Welcome to the InfoMullet YouTube channel. If you enjoy this content, please like or share. And if you'd like to support the InfoMullet by becoming a mulleteer, visit us on Patreon. We appreciate your support. Last week, someone asked about the trends in forbearance and delinquency in home loans and rental agreements and things like that. So I pulled up some data to look at this because remember, coinciding with the reopening was this belief we'll have this economic rebound. And they're doing it. I mean, again, it is a false dichotomy to say that we need to prioritize people's health or the economy. Whoever's making an argument in favor of either is missing the point. The economy and the people are one. The economy does not run without people. It does not run without confidence. And people don't run without the economy after a certain amount of time. You can't really divide them and say, well, we're going to it's okay to have no economy and people. That doesn't work for a while. It certainly doesn't work if you say, well, it's okay to have economy and no people. You know, that doesn't work either. So what happened was, as these states reopened, you began to get some movement, but we're now starting to see the data come in on this forbearance and delinquency question. So I wanted to pull up some charts. These come from Calculated Risk. As I said, Calculated Risk blog is really my go-to spot for economic charting. They do a great job. Their links are in there. I'd go check them out. So when you think about the ladder of economics and real estate, if you don't own your house, you start as a renter. You pay renter to a landlord or a landlord's agency. That landlord is the next step up on the ladder. They often don't own their own property. If they own their own property, they take it, they pocket the money, but they often pay a part of that rent to a mortgage processor. The mortgage processor is now the third tier. The mortgage processor usually pays to a bank that owns the note, and the bank that owns the note has to pay out and show a return for its investors and often for the government because the government's backing the loan. So when you think about this cascading chain, you can't just isolate one piece of it without having a ripple effect. However, one of the good news stories is that while Congress was going on all these stimulus stuff, the Federal Reserve moved in at the top level and went to the banks and said, we will keep you from collapse. Because think about it, if you're a bank and you're not receiving your mortgage payments from tens of thousands of people, you're right back to where we were perhaps in the worst of the financial crisis. You're looking at liquidity, you're looking at insolvency, and worse is the confidence of your traders or your people engaging the bank drops. You're going to have a real problem with the bank. So the Fed said to the banks, we have your back. We will not let, we will offer literally trillions of dollars of loans to backstop you so you don't have to collapse because of COVID. None of those loans have been made on the Fed. They didn't even have to be made. This is a sophistication of the Fed. The Fed said simply by making it public that we will protect you, they cut out the confidence trap loop that went down and destroyed Bear Stearman's and Lehman Brothers, where people said no one's going to bail them out, they're going to go, and they just went down the toilet. Well, underneath that, you still have to have protection for the mortgage processors that are paying the banks. Fannie and Freddie finally did that. And at the bottoms up, you have governors that are like, hey, rent, we're going to do rent forgiveness or rent freeze or things like that. And that protects both the renters and the landlords. Remember, if the renters don't have to pay rent, but the landlords still have to pay the mortgage, well, it's still a problem. So you've got two efforts at the top of the bottom. And what you see, the first thing is they're very quick to move into forbearance. Forbearance is a form of delinquency that's kind of like a permission slip. It's like, we know you're in delinquency. It's okay. It's not going to hurt you. So forbearance is like a predecessor step to delinquency, even though it's technically delinquency. Like if you're in a forbearance program, it's not going to hit your credit rating. It's not going to be a negative. And you can see here that the historical amount here is March 2nd. We're talking about fractions of a percentage point, and you can see the forbearance increase as the Fed began its programs. And these are the different types: Ginnie Mac, Fannie, Freddie, other private, and the total. You can see the level. So Ginnie is the highest at almost 10% of the entire portfolio of Ginnie loans are now in some sort of forbearance. That means there's no money coming in, but we're okay with that because it's a structured forbearance and we know it, right? That's different than I was expecting money, I didn't get money. All the way down to 6.2, Fannie and Freddie is the lowest. So you see here the forbearance, which is a leading indicator of delinquency. Now these are, this is the entire portfolio and it's backed by the government for the most part. So this could include some private, but it's mainly homes and things like that. Delinquency is after 3 months of failure to pay, when you're not in a forbearance program, you're called in delinquency, or you're in foreclosure. So this chart is calculated risk chart that this is the percent of single family loans that are in delinquency. This is a yearly chart. So each one of these things down here is a year. And you can see here, they've color coded. The blues are the major recessions. And you can see here, Fannie Mae and Freddie Mac, and you can see the financial crisis of 2000, really it begins 2007. You can see it take off and accelerate with the housing collapse. So you can see the sort of historical bad news delinquency rates as they increase. And we've of course been working through that, and we're sort of getting through that. You're only just now beginning to see a blip up in delinquency. And that will probably increase a lot more, because one of the definitions of delinquency is you're 3 months over without paying. So we're at July 1st now. If you stopped paying your rent in April and haven't paid it April, May, June, you're just going to show up in next month's delinquency report, in the July report. So this isn't really an accurate, this is a bit of a time lag right now. That forbearance is a leading indicator, but remember, those are permission. The delinquency will probably be less than that, and because we have a good forbearance system and a good backing in place with the rent freezes at the bottom level and the protection of the lenders at the higher level, I don't think we're going to see the pressure to sort of that we saw with the housing collapse. And that's probably a good news thing, because we really, anything we can do to keep the economy stable while we're doing this is really important. The other half of this is the jobs report came out today. So the jobs report, people were looking at last month's job report and it had a sharp increase. Well, it was the consensus for, let me pull this up here. The consensus for today is this is this is private sector from ADP. So this is based off salary payments that ADP processes. They estimate the number of jobs added or lost. The consensus estimate was about 3 million jobs added, and for the unemployment rate to decrease to 12.3%. They added about 2.3 million jobs in May and June. So it was less than what was anticipated, but it's a big number that was added, and this is because you see states reopening and things like that. Now, there is a little bit of question in the BLS numbers. They'll come out on Friday, I think. The BLS is the Bureau of Labor Statistics. That's the government source that does the same kind of measure. The government source has a way of testing you were employed, but you weren't able to go to work, and that's that's probably a better thing for people who are sort of because the businesses are closed. But it shows that there are signs of the economy returning to life. The problem is this is under a period of time, May through June, when everything's reopening, right? This is not even in June yet. So this is going to have that potential oscillating faction where the confidence get crashed. If these businesses went out and rehired, they got some commerce in, the outbreak spread like wildfire, and now they have to close again, or they have to come down, or people begin withdrawing their consumer activity, you're going to be right back into the same problem we were in April, May, except now you have even worse confidence because the businesses are kind of like once burned, twice shy. And next week, what I'll probably do next week or the week after is I'll take a look. There's some high frequency indicators in the economy that really tell you very well, better than the government, analysis of how the economy is doing. It's miles driven, it's restaurant occupancy rate, it's hotel occupancy rate, it's travel, it's movie sales. I know Tyler has been tracking the movie. There's a certain movie he's tracking, when it's going to come out or not. These indicators tend to be barometers of economic velocity, and you could see them drop dramatically for COVID, stay flat, but now they were coming back up. And so if you're having a V-shaped recovery, let's pretend there's no pandemic, you want to see them come back up fast. That's a good sign. The problem here is with the renewed outbreak of 1.5, are they going to go up and then reverse and come back down? Thanks for watching the video. Hope you enjoyed it. If you'd like to follow the InfoMullet, visit us on Facebook or Twitter. And if you'd like notifications when we post new video content, click on the red subscribe button below the video. If you've ever wanted to become a mulleteer and support the InfoMullet, visit us on Patreon. We appreciate the support.